Friday, January 30th, 2026 is going to be remembered. People will write about it in economics textbooks, dissect it in market forensics classes, and rank it among the nastiest one-day precious metals collapses since 1980. Gold sank roughly 12% from Thursday's record peak above $55.94 to under $4,900. Silver suffered an all-time kind of intraday shock, down 25% to 35%, dropping from around $120 to about $85. That's a $35 wipeout in a matter of hours. If you're hurting right now, if you checked your portfolio Friday night and felt your stomach flip, if you started asking yourself whether the bull market is over, whether you should have sold the top, whether everything we tracked for months just vanished, you're not alone. But this wasn't a normal correction. This wasn't a healthy pullback. This was a political earthquake wearing a market event disguise. This was a rug pull at the highest levels of power, one that even top institutional traders didn't see coming. So what happened? What? Did President Trump just switch sides? Did he betray the weak dollar stance he was selling only 72 hours earlier? Did he intentionally smash precious metals to send a message? If you want the real story behind the Kevin Warsh nomination, make sure you're subscribed right now and turn on notifications, because what I'm about to lay out changes the entire narrative. The link between Trump's Tuesday in Iowa, the Friday morning announcement, the dollar spike, and the metals massacre isn't an accident. It's a coordinated policy shift, one that Wall Street is calling either the biggest political betrayal in modern financial history or the most brilliant strategic monetary repositioning since Paul Volcker. So do this now. Subscribe and keep notifications on, because the timeline matters, the wording matters, the timing matters. And once you connect the dots, you realize Friday's crash had nothing to do with fundamentals. It was politics. Let's run the sequence. Tuesday, January 27th, 12:45 p.m. Eastern Urbandale, Iowa. Trump is speaking with local business owners in a press gaggle. A reporter asks about the U.S. dollar sliding to a 4-year low. The dollar index DXY had dropped to 95566, its weakest level since February 2022. And Trump's answer, these were his exact words, was basically, no, I think it's great. I think the value of the dollar is it's doing great. He didn't stop there. He explained why. He said, quote, if you look at China and Japan, I used to fight like hell with them because they always wanted to devalue. A weak dollar means you can sell tractors, you can sell trucks, you can sell anything. That wasn't some random slip-up. Trump had been pushing the same message for months. Back in July 2025, he made it even clearer. He said, when we have a strong dollar, one thing happens. It sounds good, but tourism is bad. You can't sell tractors, you can't sell trucks, you can't sell anything. You make a hell of a lot more money with a weaker dollar. Not a weak dollar, but a weaker dollar than you do with a strong dollar. The market understood exactly what he meant. The dollar kept sliding, gold kept climbing, silver went vertical. Traders interpreted Trump's comments as an open green light for dollar debasement. Think about how massive that is. The President of the United States openly endorsing currency weakness. And if the administration wanted a weaker dollar, the Fed would have to play along. That meant more rate cuts. That meant QE. That meant the same easy money pipeline that fueled the 2020-2025 boom keeps flowing. Gold to $6,000, silver to $150. That was the trade. And then Friday morning hit. Between 4 a.m. and 4:23 a.m. Eastern on January 30th, Trump posts on Truth Social. He's nominating Kevin Warsh to replace Jerome Powell as Fed chair. Trump said, quote, I have known Kevin for a long period of time and have no doubt that he will go down as one of the great Fed chairmen, maybe the best. And the market instantly froze and went, wait, what? Kevin Warsh, 55 years old, former Fed governor from 2006 to 2011, Ben Bernanke's key Wall Street liaison during the 2008 crisis, and broadly known as an inflation hawk and balance sheet reduction guy. That's not weak dollar. That's not print money. That's not endless liquidity. That's a sound money operator who spent years criticizing the Fed's easy money era. Here are Warsh's core beliefs in plain terms, straight from the ideas he's repeatedly pushed. Inflation happens when government spends too much and prints too much. Money is too easy on Wall Street, while credit stays too tight on Main Street. And his preferred policy path looks like this. First, shrink the Fed's bloated $6.8 trillion balance sheet through aggressive quantitative tightening. Second, reject the idea that growth and rising wages are the main cause of inflation. Third, only cut short-term rates after liquidity has already been drained by a balance sheet reduction. Fourth, push a full regime reset inside the Fed to rebuild credibility. Do you see the collision here? On Tuesday, Trump says a weak dollar is great. On Friday, Trump picks a strong dollar hawk. One of those positions cannot be real. Either Trump was lying Tuesday to steer markets, or he's lying now with this nomination. Or, and this is the most dangerous possibility, he doesn't even grasp the contradiction and is making decisions off relationships and vibes instead of a coherent strategy. The market response was immediate and savage. The DXY ripped from about 95.55 to around 97.15, roughly a 1.7% jump. That was the biggest one-day move in the dollar index since July 2025. The euro dropped hard against the dollar, down about 1% as safe haven flows reversed. The yen weakened too, even with earlier intervention rumors, because the dollar strength overwhelmed the risk-off mood, and precious metals, they got obliterated. Gold sank from Thursday's 55.75 record to an intraday low near 4,700, about a 14% drawdown. It finished around 490, roughly a 10% loss on the day. Silver collapsed 30% to 35% intraday from $120 to lows near 76.50 before stabilizing around $85, the worst single-day percentage wipeout in 46 years. The gold-to-silver ratio spiked to about $501 from 46.2 to 8, showing silver was getting punished disproportionately, and miners, they were shredded. Pneumatic thorium dumped around 11.5% to 11.1230 on massive volume, about 85% above average, nearly 19.1 million shares, traded around 14B and market cap erased. Barrick mining ticker B fell roughly 12.1% to 45.74. 31 million shares, traded volume up about 91%, around $9B and market cap wiped Hecka down 12%. Freeport McMoran down 7.5%, GDX down 11.9%, GDXJ down 13.7%. Both posted their worst sessions on record. SLVI shares. Silver Trust collapsed 28% to 31% intraday, its steepest one-day drop ever. GLD SPDR Gold shares fell about 10.5%, tracking toward its worst day on record. AGQ Pro shares, Ultra Silver, down about 25% pre-market. This wasn't a dip, this was liquidation. This was forced selling on a scale we haven't seen since the Hunt brothers blow up in 1980, when silver fell about 27% on Silver Thursday after margin rule changes triggered mass liquidations. And this is where it ties directly to our last video, because if you've been watching this channel, you know we covered Thursday's Microsoft crash. We broke down how Microsoft dropped about 10% and wiped roughly $357 billion in market cap. We explained how that triggered margin calls across hedge funds. Those funds were long tech and long precious metals at the same time. When Microsoft got smashed, their prime brokers demanded collateral. Post more right now, or we liquidate. So what did they dump first? Their most liquid assets. Gold became the perfect ATM to raise cash. And as one analyst put it, when volumes are huge and leveraged longs are stretched, it doesn't take much to trigger the kind of move we saw on Friday. Microsoft set the stage. The worst nomination was the match, and together they created a liquidation waterfall that erased 46 years of support levels in hours. The warning signs were already flashing. Gold's RSI, the relative strength index, was near 90, the highest in decades. Over 70 is overbought. Near 90 is basically one spark away from a brutal pullback. Silver's RSI was elevated too, with price more than 100% above the 200-day moving average. Historically unsustainable. Analysts were warning that the near-term technical setup was stretched, so when the worst headline hit at 4 a.m. and the algorithm scanned words like inflation hawk, balance sheet reduction, sound money, strong dollar, they didn't hesitate. They sold instantly, aggressively, without mercy. Because if Wersch is confirmed and actually runs aggressive QT without offsetting QE, the liquidity conditions that powered 2020-2025 asset inflation get ripped away. And as one analyst warned, this crash wasn't only fear, it was recalibration. For the first time in years, markets were forced to face a reality they've avoided. Easy money isn't guaranteed. Markets instantly priced in a world where rate cuts could happen alongside balance sheet reduction, not alongside endless QE. And if rate cuts don't automatically mean QE, then risk assets have to reprick under tighter liquidity. Gold at $5,600 was priced for infinite QE. Gold at $4,900 is priced for worse style tightening. Now let's hit the political angle because the media immediately framed this as a betrayal. The Wall Street Journal ran, "What might Kevin Wurz do as Fed chair?" highlighting the view that growth and wage gains aren't the issue and that inflation comes from too much spending and printing. Reuters amplified Trump's earlier message. Strong dollar sounds good, but you make more with a weaker one. CNBC analysts described Wurz as the end of the easy money story. Political economists pointed out the chaos. One argument went like this: Trump's tariffs added roughly half a point to inflation in 2025. The national debt sits near $36 trillion. Entitlements are on autopilot. None of that gets solved with sound money. It gets managed through slow inflation over decades. And here's the kicker. As of Saturday morning, Trump still hasn't publicly explained the contradiction between his weak dollar talking points and his selection of a strong dollar Fed chair. Treasury Secretary Scott Bessent reaffirmed strong dollar policy on January 28th, making it even more confusing. So now we have Trump, weak dollar is great Tuesday, Trump strong hawk Fed chair Friday, Bessent strong dollar policy Wednesday. So what is the actual policy? Nobody knows, and that uncertainty is poison for markets. Let's look at the destruction across assets. Silver's drop was especially savage, down $35 in one session. Analyst Michael Brown at Pepperstone described it like every man and his dog trying to exit at once. The scale arguably beat even 1980. On March 27, 1980, Silver Thursday, silver fell 27% due to margin liquidation. Friday's 30% to 35% intraday drop was worse. Outflow numbers are still being finalized, but early reports showed SLV down 28% to 31% intraday, with forced liquidation dominating as margin calls cascaded. GLD fell about 10.5%. AGQ fell about 25% pre-market, amplifying the pain for leveraged holders. And here's the brutal irony. Just days earlier, SLV pulled in a record 171 million of retail buying on Monday, January 27th, nearly double the previous one-day record from the 2021 Reddit silver squeeze. Those retail buyers who chased $110, $115, $120 got nuked within 72 hours. They bought the top and got wrecked. The institutions who sold into that demand, they're fine. They unloaded high and can reload at $85. Now, for the question everybody cares about, is the bull market dead? Is this the end of the rally? Do you sell, hold, buy the dip? Let's go straight to what the big institutions are saying because their stance hasn't flipped. UBS raised its gold target to $6,200 for Q1, Q3 2026 in a note dated January 29th, just hours before the crash. Their argument was that long-term diversification buyers won't dump, raising the baseline price floor. UBS reaffirmed their buy Friday morning, and as of Saturday, there was no revision. Goldman Sachs set a December 2026 target around $5,400 on January 22nd. No update after the crash. Morgan Stanley's bull case for H226 is $5,700, no revision. Deutsche Bank's December target is $6,000, no revision. JP Morgan's Q4 target is $5,000 with an upside scenario near $8,000, no revision. As of Saturday morning, no major bank has pulled their bullish thesis. Why? Because the underlying drivers of the 2020-2026 metals run are still active. Let's walk through them one by one. First, central bank buying. Central banks bought about 863 tons of gold in 2025, slightly below the 2022-2024 average, but still historically huge. Goldman Sachs projects around 60 tons per month in 2026, about 26% of annual mine output. This is structural diversification away from dollar assets, boosted by sanctions risk and geopolitical fragmentation. China's central bank bought gold for 13 straight months through October 2025, adding 53 tons that month alone. Poland's buying shows it's spreading beyond the usual players. Second, the $38 trillion debt problem. U.S. debt passed $38 trillion in October 2025, about 120% of GDP, and it's still rising faster than the economy. The Committee for a Responsible Federal Budget warned Thursday that some kind of crisis becomes likely without correction, laying out multiple paths: financial crisis, inflation crisis, currency crisis, Default crisis, austerity crisis, or a long grinding gradual crisis. Interest costs hit about $1 trillion in 2025, about 18% of federal revenue, more than the entire Medicare budget. And here's the hard truth. Wersch can talk tough, but he can't fix $38 trillion. He can tighten. He can shrink the balance sheet. He can raise rates. But the government still can't repay that debt without inflating the currency. The math doesn't allow sound money politically. The only feasible path is controlled inflation, slow debasement over decades, while officials keep pretending it's all about price stability. Third, geopolitical risk and policy uncertainty. Trump's January 2026 actions threatening Greenland annexation, launching probes of Fed officials, conducting operations in Venezuela, demanding Iranian negotiations with retaliation threats have boosted risk premiums. The Sell America mood that surged after the April 2025 Liberation Day tariffs is creeping back. Fourth, silver's industrial demand. Unlike gold, silver has a huge structural industrial bid, especially solar panels. The Silver Institute projects about 6.65 gigawatts of global solar PV capacity in 2026, implying 125 million ounces of silver demand. Add 14 to 15 million EVs using another 75 million ounces, plus grid upgrades and data centers adding 15 to 20 million ounces. Industrial demand is now over half of silver usage, up from about 40% a decade ago, creating supply deficit pressure that gold doesn't have in the same way. So yes, Friday was brutal, but the core fundamentals didn't suddenly die. Also, those RSI readings that were extreme overbought Thursday likely flipped to oversold potentially under 30 by Friday's close. Historically, violent flushes like that often create opportunity. Momentum traders get wiped out and deeper-pocketed buyers accumulate lower. Even after Friday's carnage, gold was still up about 18% in January, roughly $700, above $4,300 from January 1st. Silver was still up about 11% to 19% for January, even after losing $35 on Friday. Both metals still posted their strongest January in over 4 decades. Manav Modi of Model Oswald noted gold dropped more than 5% intraday, its sharpest since October 2025, yet remained on track for its strongest monthly performance since the 1980s. He framed Friday as forced liquidation by over-leveraged speculators intensified by equity weakness and margin calls. Again, gold as the perfect ATM. Michael Brown of Pepperstone pointed to the same cause. Huge volumes, stretched leverage, and it doesn't take much to spark a move like Friday. So here's my assessment. If worse gets confirmed and executes aggressive QT without QE to offset it, the liquidity world that powered the 2020-2025 boom changes fast. Markets are being forced to price a reality they ignored. Easy money isn't guaranteed. But Trump's weak dollar messaging on January 27th and his strong dollar hawk pick on January 30th cannot both be true. That means one of 3 outcomes is coming. Outcome 1, Trump pressures Wersch to fold. Wersch talks hawkish but governs dovish. The dollar resumes falling. The metals rally resumes. Outcome 2, Wersch stays independent. He runs QT and slower cuts. The dollar strengthens. Metals chop and consolidate lower for 62 months. Outcome 3, Wersch fails confirmation. Trump picks a compliant dove. Maybe Rick Rear from BlackRock. Easy money comes back. Gold and silver rip higher. Friday was priced his betrayal. Trump's base expected a dovish Fed chair aligned with a weaker dollar agenda. Instead, they got a sound money advocate who rejects the QE machine. But here's the deeper reality. America cannot afford sound money. With $38 trillion in debt, $1 trillion in interest, and entitlements locked on autopilot, controlled inflation is the only politically survivable path. So Wersch may be tactically bearish. Maybe a 6 to 12-month consolidation, but strategically irrelevant. The debt trap force is eventual debasement, regardless of who sits in the chair. So, what should you do? For tactical traders, wait for confirmation. Watch $4,500 support on gold and $80 on silver before adding. Stay away from leveraged ETFs like AGQ and NUG until volatility cools. Keep an eye on VIX below 20 matters. Track the DXY. If it breaks above 98, metals could have more downside. If it falls back below 95, that's a bullish reset signal. For long-term investors, Friday was a gift. 10% to 15% off all-time highs. Central bank buying, the debt crisis, and geopolitical risk didn't vanish in one day. Dollar cost average into physical gold and silver over 3 to 6 months. Ignore the intraday chaos. Friday's meltdown was a reminder. Parabolic moves always end with tears. Leverage gets punished. Retail FOMO gets punished. Momentum chasing gets punished. Just like 1980, 2011, and every blow-off top in history, but the 2026 bull case is stronger than 2025. Central banks are still buying 800 plus tons per year. U.S. debt is still on an unsustainable path. Some form of crisis remains likely. Iran, China, Ukraine keep safe haven demand alive. Silver's industrial demand, solar, EVs, data centers keeps tightening supply. Gold still held an 18% January gain. Silver still held an 11% January gain after a $35 crash. Wirsch brings tactical chaos, but he can't change the strategic trap. The U.S. will inflate away the debt because there is no other option. The tourists are gone. The margin calls hit. Now we're back to the kind of violent two-way metals market that bulls forgot exists. If you've got conviction and capital, Friday may end up being the opportunity of the decade. Weak hands got rinsed. $85 silver is a gift. If you believe the debt crisis ends in debasement, now Monday is the test. Monday decides bounce or break. Do you trust Trump's move? Was this a brilliant strategic repositioning or a massive policy error that markets will pay for all year? Drop your take in the comments. And if you're buying this dip, if you held through Friday, if you see $4,900 gold and $85 silver as the moment you've been waiting for, smash the like button right now. Subscribe and turn on notifications because when markets reopen Monday morning, we'll see whether Friday was capitulation or the first crack in a decade-long bubble. The bull market isn't dead. It's just entering the violent phase. It's going to be volatile. It's going to be ruthless. And you need to be here for every move. Stay sharp. I'll see you in the comments, and I'll see you Monday when we break down what happens.